I get asked this almost every single week. Matteo, I have crypto, I've made money in crypto, I'm getting paid in crypto. How do I turn it into fiat without getting my bank account shut down? And this is where most people get it completely wrong, because the problem is not crypto. The problem is how you structure your banking. I'm Matteo Maglia, Partnership Manager at GloboBanks, the banking introduction company for international accounts. And today, in this video, I want to break down very clearly how to bank with crypto in 2026 without freezing your funds, without getting the backend, and without waking up one morning to your account has been closed email. Let's start with something very important. Banks do not hate crypto. What they hate is uncertainty. They hate unclear source of funds. They hate sudden six-figure wires with no history. They hate accounts that were declared as consulting services and suddenly receive transfer from exchanges every single week. They hate inconsistency. Crypto is not illegal, but crypto-only banking, poorly structured, is considered high risk from a compliance perspective. And that's where people blow up their accounts. So, instead of talking about specific banks, today I'm going to explain the three real models that work. Model number one, traditional banking will lie to crypto exposure. This is what most small and medium entrepreneurs try to do. You have, for example, a US LLC or an European company. You open a standard business bank account, you have a real business activity, client payments, invoices, operational expenses. And then you introduce crypto flows on top of that. Small, proportional, consistent. If your company is doing like $200,000 per month in client revenue and like 15,000 or 20,000 comes from crypto on-ramp or off-ramp activity, usually is manageable. Why that? Well, because the account has context, it has economic substance, it has history. Where people make the mistake is when 100% of the inflows are crypto. No real operating activity, no invoices, no narrative. That's when compliance flags go up. The advantage of this model is simplicity. The downside is fragility. If crypto becomes the dominant activity, you're exposed. Model number two, crypto-friendly jurisdictions. Now, this is where things get more interesting. Certain banking jurisdictions are structurally more open to international flows and digital asset exposure. Not because they are loose, not because they are reckless, but because their banking system are built around cross-border capital. One of the strongest examples in the Americas is Panama. Panama is a regional financial hub, dollarized economy, strong banking regulator, deep correspondent relationships, and most importantly, banks that understand international clients. Now, let me be very clear. Panama is not a secrecy haven. It complies with the CRS. It shares information where required. It follows due diligence rules. But it is structurally more comfortable with international entrepreneurs who, for example, trade digital assets, operate globally, hold offshore companies, move capital between jurisdictions. The deposit requirements are often lower than private banking in Switzerland or Singapore. Remote opening are possible depending on the profile, for sure, and multi-currency capabilities are strong. The trade-off? Fees can be slightly higher. Due diligence is real. Documentation must be clear. But if it's structured properly, this is a much more stable environment for crypto exposure compared to a random fintech account opened in 5 minutes. Then, the model number three, premium and private banking. This is not for everyone. This is for larger exits, for high net worth individuals and for founders who sold tokens, for family offices transitioning digital wealth into traditional assets protection. Jurisdictions like, for example, Singapore, Switzerland or the UAE offer very stable private banking environments. These are not crypto banks, they are capital preservation banks. They care about long-term relationships, asset under management, investment strategy, intergenerational planning. If you made a serious crypto exit, a cash out, a very big cash out, and you're sitting on 7 or 8 figures, this is not about Kraken transfers anymore. This is about wealth transition. The deposits are higher, the onboarding is stricter, the scrutiny is deeper. But for sure, the stability is exponentially stronger. Now, let's address the physiological contradiction here. Crypto was designed to avoid banks, but the moment you did fiat, F-I-A-T, the moment you need to buy real estate, the moment you need to pay employees, the moment you want a mortgage, you need banks. And the on-ramp and off-ramp is the weakest link in your entire structure. Most account closures don't happen because of one big transaction. They happen because of mismatch between declared activity and real activity, poor explanation of business model, no secondary banking backup, improper structure between residency, company and banking. For example, someone lives like in the UAE, owns a Hong Kong company, has clients in Europe also, uses a US fintech account, receives crypto from multiple exchanges and never properly explains the structure. From a compliance officer's perspective, that looks chaotic, even if it's fully legal, you know? That's why structure matters more than the volume. Another mistake people make is using personal accounts for business crypto activity, or using one single bank for everything. But smart entrepreneurs often separate operating account, liquidity account, reserve account, and in some cases an offshore diversification account. And that's not because they are hiding something, but because concentration risk is real. We've seen too many cases of, for example, accounts frozen for 30, 60 or also 90 days, funds held during enhanced due diligence, clients unable to pay contractors because one bank decided to review activity. Crypto didn't fail them, structure did. And there's something most people don't understand. In 2026, crypto is easy, fiat is hard. The real bottleneck is not blockchain, it's compliance. You know, banks today are under pressure from regulators, from correspondent banks, from risk committees. They would rather close a gray account than spend time understanding it. So your job is to never look gray. You must look structured, predictable, economically coherent. Now, at GloboBanks, we don't open crypto bank. That's not what we do. We structure international banking for entrepreneurs who have crypto exposure. The first thing we look at is where do you live? What passport do you hold? What does your company do? What jurisdictions are involved? What volumes are we talking about? Is this trading? Is this token allocation? Is this mining? Is this consulting paying in crypto? Only after that do we suggest a jurisdiction. Sometimes it's Panama, sometimes it's Europe, sometimes it's Singapore, sometimes it's something completely different for you, for example. But the key is alignment. So if you are serious about turning crypto into fiat in 2026 without risking your entire banking structure, think strategically. Don't ask what the easiest bank, ask what structure makes sense for my profile. Because in this market, banking is no longer administrative, it's strategic. Crypto gave you freedom. Banks determines whether you keep it. If this video helped you understand the landscape better, make sure you subscribed. And if you want to understand whether your current structure is stable or fragile, there's a free assessments link below where we analyze the profiles before suggesting anything. No pressure, just clarity. And in this environment, clarity is leverage. I'll see you in the next video.